37% in a single day, with no breaking news, no emergency announcement, and no clear explanation. That kind of move doesn't happen naturally. On Friday morning, silver was trading around $121. By the end of the same trading day, it was near $75. $46 erased in just a few hours. Gold followed the same path, dropping from about $5,600 to $4,700. Nearly $900 gone. And what makes this moment so disturbing is not just the size of the drop, but the complete absence of a trigger. No war started, no pandemic emerged, no major bank failed. There was nothing unusual on the news wires. Yet we just witnessed one of the largest single-day crashes in precious metals in years, and almost nobody is explaining why. This wasn't random. It wasn't normal volatility. It followed a pattern that has appeared before, and once you see it, you can't unsee it. Friday morning, January 30th, the final trading day of the month and the week, silver was sitting comfortably at 121. January had been extraordinary. Silver was up roughly 65% in just 30 days, its strongest monthly performance in decades. Optimism was everywhere. Analysts were projecting prices of $200, even $300. Social media was full of celebration. People believed they had caught the rally of a lifetime. Confidence was high, emotions were running hot, and the mood across the market was pure euphoria. Then, the New York market opened at 9:30 a.m., and within seconds, everything changed. A massive wave of sell orders hit the market almost simultaneously. These were not small retail trades. These were institutional-sized blocks, millions of ounces being dumped at once. Silver slipped from 121 to 115, then to 110, and within minutes it broke below 100. That level was supposed to be solid support. Many believed it would never break. It didn't just break, it vanished. Prices kept sliding. Stop-loss orders triggered automatically. Margin calls started rolling in. Traders were forced out of positions they never intended to sell. By the close of the day, silver was sitting at 75 and gold at 4,700. In just 6 hours, hundreds of billions of dollars in value were erased. Fortunes disappeared. Years of gains were wiped out before most people even understood what was happening. That night, everyone asked the same question. What changed? What caused this? And the answer most people heard was simple. Nothing. Commentators called it a healthy correction. They said markets had run too far, too fast. They said this was normal behavior. But that explanation falls apart the moment you look beneath the surface, because something did change, and it didn't happen on Friday. It started weeks earlier, quietly, when almost no one was paying attention. Look at the 60 days leading up to the crash. On December 12th, silver was gaining momentum and making headlines. That same week, the CME Group, which controls silver futures trading, raised margin requirements by 10%. It barely made the news. On December 29th, silver kept climbing, showing no sign of slowing down. Margins were raised again, this time by 25% overnight. Then, less than 24 hours later, margins were raised yet again. 2 increases in 2 days, something that almost never happens. And then, on January 28th, just 3 days before the crash, the system itself was changed. The CME moved from fixed dollar margins to percentage-based margins, raising requirements once more. In total, margins increased by roughly 80% in just 6 weeks. To understand why this matters, you need to understand how leverage works. When traders buy silver futures, they don't pay the full price up front. They put down a fraction as collateral, known as margin. That leverage amplifies gains, but it also magnifies risk. When margin requirements are raised, every trader holding a leveraged position must immediately add more cash to their account. Not next week. Not when it's convenient. Immediately. If they can't, their positions are liquidated automatically. No discussion, no appeal. The system sells for them. Most traders don't have an extra 80% in cash sitting idle. When thousands of traders are forced to sell at the same time, prices don't slowly adjust. They collapse. That is exactly what happened on Friday. This wasn't the market calmly finding fair value. This was forced liquidation, triggered by rule changes. And what makes this even more unsettling is that this exact mechanism has been used before. This wasn't the first time this playbook was used, and that's the part most people miss. If this had only happened once, it could be dismissed as an accident. If it happened twice, some would still call it coincidence. But when the same sequence appears again and again across decades, it becomes something else entirely. In 1980, silver surged from around $6 to nearly $50 in just a few months. Ordinary investors were making life-changing gains, and pressure began building inside the financial system. The response was immediate. The CME introduced what became known as Silver Rule 7, effectively banning leveraged buying overnight. If you wanted silver, you had to pay in full. At the same time, the Federal Reserve raised interest rates sharply. The result was devastating. Silver collapsed from $50 to near $10, wiping out nearly 80% of its value. The rally ended, not because demand disappeared, but because the rules changed. Fast forward to 2011, and the same story plays out again. Silver climbed from roughly $8 to $50, a 600% move that pulled retail investors into the market in massive numbers. Banks with large short positions were under pressure. Once again, the response didn't come from the market itself. The CME raised margin requirements 5 times in just 9 days, an 84% increase. The impact was immediate. Silver fell from 50 to 26 in a matter of weeks. More than half the value vanished, and it took over a decade for prices to recover. 2 major silver rallies, 2 abrupt margin interventions, 2 collapses. Now, in 2026, we've seen the third act of the same script. This time, silver ran from the mid-20s to over 121, a rally larger than anything seen in modern history. Once again, margin requirements were raised repeatedly in a short window, 4 increases in 6 weeks. Once again, forced selling followed, and once again, prices collapsed in dramatic fashion. 3 times in 50 years, the same setup, the same tool, and the same outcome. At that point, it's no longer reasonable to call this random. The pattern is too consistent. So why does silver trigger this kind of response? The answer isn't about silver as a metal. It's about what precious metals signal. Gold and silver rise when confidence in paper money weakens. They act as a mirror, reflecting stress in the financial system. And right now, that stress is growing. The United States relies on the dollar's role as the global reserve currency. That status allows massive deficits, constant borrowing, and continuous money creation. But that system only works as long as the world believes in it. And that belief is slowly eroding. Central banks around the world have been quietly shifting their reserves. Instead of buying U.S. Treasury bonds, they are accumulating physical gold. Last year alone, they bought hundreds of tons of it. In just one recent month, tens of billions of dollars worth of U.S. Treasuries were sold. The dollar's share of global reserves has fallen to its lowest level in decades. For the first time in modern history, gold now represents a larger portion of central bank reserves than U.S. government bonds. That isn't a headline you see often, but it's a fundamental shift in trust. Leading this movement are countries like China, Russia, India, Brazil, and South Africa. These nations are building trade systems that don't rely on the dollar. They are settling transactions in local currencies and stockpiling physical resources. China, in particular, has spent decades positioning itself at the center of global supply chains. It controls the majority of the world's silver refining capacity. Not mining, refining. Silver can be pulled out of the ground in many countries, but without Chinese refineries, it can't easily reach the global market. And silver is just one piece of a much larger puzzle. China processes nearly all of the world's rare earth elements, controls most gallium refining used in semiconductors, and handles the majority of cobalt and lithium processing critical to batteries, electric vehicles, and military systems. Earlier this year, China officially classified silver as a strategic resource and imposed export controls on it. That move placed silver in the same category as materials tied to national security. While Western markets were liquidating paper contracts, China was securing physical supply. This highlights the deeper divide forming in the global system. The West largely trades financial instruments, futures, and promises. The East is accumulating physical assets. One side is focused on price. The other is focused on possession. And that difference matters, especially during moments like Friday's crash. While traders in the U.S. were being liquidated and forced to sell, physical silver was moving quietly into long-term storage elsewhere. That contrast tells you who is thinking in weeks and who is thinking in decades. What made Friday even more revealing was what was happening in the physical market at the same time. Before the crash, when silver was still trading above 120, mints around the world were already struggling to keep up with demand. Some had suspended wholesale orders because backlogs were growing too large. Dealers were reporting delays, and certain products were becoming harder to source. Even at elevated prices, physical silver was not freely available. That alone should have raised questions. After the paper price collapsed to 75, the situation didn't suddenly improve. Try buying physical silver now, and you'll see the disconnect immediately. Premiums remain high, inventories are thin, and in some cases, products simply aren't available. The screen may say one price, but the real-world market is telling a very different story. That's because paper silver and physical silver are not the same thing. Paper silver is a contract, a promise, an obligation that exists inside a financial system governed by rules that can change overnight. It can be created with a keystroke, expanded through leverage, and crushed through margin adjustments. Physical silver is different. It exists outside that system. It cannot be printed, margin called, or erased by a rule change. When you hold physical metal, there is no counterparty risk. No exchange can force you to sell it. Friday exposed that divide more clearly than ever. While Western markets were dumping contracts and absorbing forced liquidations, something very different was happening elsewhere. In Shanghai, large amounts of silver were being withdrawn from vaults, not sold on the market, but removed for delivery. This has been an ongoing trend. Physical metal has been steadily moving east as Western markets focus on paper trading. One side is trading numbers on screens, the other is accumulating real material. That difference becomes critical when volatility hits. And through all of this, the fundamentals never changed. Silver has been in a supply deficit for several consecutive years. Since 2021, more silver has been consumed annually than has been mined. The cumulative shortfall is massive, approaching the equivalent of an entire year of global production. Industrial demand continues to rise, driven by solar energy, electric vehicles, electronics, data centers, and defense applications. At the same time, new mine supply is limited. Ore grades are declining, production costs are rising, and bringing a new mine online takes many years. None of these realities disappeared on Friday. The deficit is still there, demand is still growing, supply is still constrained. History shows that paper prices can be suppressed temporarily, but they cannot override physical reality forever. After the 1980 collapse, silver eventually recovered. After the 2011 crash, it recovered again and reached new highs years later. The timeline is never predictable, and no one can say exactly when prices will turn. Silver could go lower from here, or it could rebound faster than most expect. Anyone claiming certainty right now is guessing. What isn't guesswork is the pattern. Margin requirements were raised repeatedly, forced selling followed, and prices collapsed. That sequence has now played out 3 times in 50 years. So the real question isn't whether silver is volatile. It's why the same measures keep being used against it. If silver truly didn't matter, there would be no need to intervene. If gold and silver were irrelevant relics, no one would care if their prices rose freely. Yet every time they gain too much momentum, the same tools appear. The explanation given is always risk management or market stability. But look at the results. Traders are wiped out, accounts are destroyed. Years of gains vanish in hours. That doesn't look like protection. It looks like defense of something larger. The dollar system depends on confidence. It depends on people believing that paper assets will hold value indefinitely. Rising precious metals challenge that belief. They send a message that purchasing power is being eroded and that physical scarcity still matters. That message is uncomfortable for a system built on unlimited expansion. Crushing silver's paper price doesn't eliminate that message, but it delays it. And delay can be valuable when you're managing a system this large. Friday wasn't just a crash. It was a demonstration of control over paper markets. But it was also confirmation that precious metals still pose a threat to the status quo. The intensity of the response reveals the importance of the target. You don't fight this hard against something that doesn't matter. Whether you choose to participate in this market or stay on the sidelines is your decision. But now you've seen the pattern, the history, and the mechanics behind the move. They called it volatility. Others called it a healthy correction. But when you line up the dates, the margin changes, and the historical precedents, it tells a clearer story. This was the same playbook used before, running once again. The data is public, the pattern is visible, what happens next is uncertain, but what happened on Friday is not. It was not random, and it was not unexplained. This is the hidden economy, and now you've seen how it really works.